Under the Bretton Woods system, USD was pegged to gold, and most other currencies were pegged to the USD. Therefore, USD was used as the main intervention currency and hence the reserve currency. Accordingly, we'll be discussing on dollar dominance and rise of non-traditional reserve currencies. US dollar has long played an outsized role in global markets. It continues to do so, although the American economy has been producing a shrinking share of global output over the last 2 decades. Although the currency's presence in global trade, international debt, and non-bank borrowing still far outstrips the US share of trade, bond issuance, and international borrowing and lending. Central banks aren't holding the greenback in their reserves to the extent that they once did. This shows the currency composition. Non-traditional currencies have played a larger role in global foreign exchange reserves in recent years. We can see that USD has reduced its position as reserve currency from around 70% to 59% as of 2021, and Euro is accountable to 21%, and Yen for 6%, GBP for 5% accordingly. As the chart shows, USD's share of global FX reserves fell below 59% in the final quarter of last year, extending a 2 decade decline, according to IMF's data. In an example of the broader shift in the composition of foreign exchange reserves, the Bank of Israel recently unveiled a new strategy for its more than $200 billion of reserves. Beginning this year, it will reduce the share of USD and increase the portfolio's allocations to the Aussie dollar, Canadian dollar, Chinese renminbi, and Japanese yen. As documented in a recent IMF working paper, the reduced role of USD hasn't been matched by these increases in the shares of the other traditional reserve currencies, namely the euro, yen, and pound. Moreover, while there has been some increase in the share of reserves held in renminbi, this accounts for just 1/4 of the shift away from dollars in recent years, partly due to China's relatively close capital account. Moreover, an update of data referenced in the working paper shows that as of the end of last year, a single country, namely Russia, held nearly a third of world's renminbi reserves. This shows Yuan stockpiling. Russia has nearly a third of all reserves in China's renminbi. Thereafter, Brazil, Switzerland, Mexico, Israel, Chile, and South Africa accountable for the rest of yuan stock holdings. By contrast, the currencies of smaller economies that haven't traditionally figured prominently in reserve portfolios, such as the Aussie dollars and Canadian dollars, Swedish kroner, and South Korean won, account for the 3/4 of the shift from dollars. Two factors may help to explain the movement into this set of currencies. These currencies combine higher returns with relatively lower volatility. This appeals increasingly to central bank reserve managers as forex stockpiles grow, raising the stakes of portfolio allocation. New financial technologies, another reason behind this movement, such as automatic market making and automated liquidity management systems, make it cheaper and easier to trade the currencies of smaller economies. In some cases, the issuers of these currencies also have bilateral swap lines with the Federal Reserve. It can be argued that this creates confidence that their currencies will hold their value against the dollar. At the same time, the importance of this factor can be questioned. The non-traditional currencies tend to float. In practice, they fluctuate wildly against the dollar. and their issuers have rarely, if ever, drawn on their bilateral swap lines with the Fed. A more possible explanation is that these non-traditional reserve currencies are issued by countries with open capital accounts and track records of sound and stable policies. Important attributes of reserve currency issuers include not just economic weight and financial depth, but also transparent and predictable policies. In other words, the stability of the economy and policy decisions matter for international acceptance. A regression analysis of global reserve currency shares confirms that a higher economic risk premium measured by the cost of using credit derivatives to insure against default reduces the currency share in global reserves. Apparently, holders favor the currencies of countries known for good governance, economic stability, and sound finances. Reference for today's presentation is from IMF blog titled as Dollar Dominance. Thanks for watching.